So we are going to look at this question, the Armstrong group, and this question is all about finance when you look at forex hedging. So it looks like the question that you shared with me one time, which I remember I was supposed to give you a solution on how to handle it, but the time when I was supposed to do it, we didn't have the class, so I didn't do it. So maybe today's question will help you to understand that, and then maybe you can go back and figure out the rest. So the question says the first part is to calculate the intergroup transfers that are forecast to occur the next period. So we are going to see what that means. That is for 7 marks. And now they're saying that there is a most important transaction which Mercy due to undertake with the company outside Armstrong Group the next 6 months, is that it is due to receive 25 million euros from Bardsley on 30th November. So the treasury manager intends to invest this money for 6 months to 31st May, going to be used to fund some major capital expenditure. However, the manager is concerned about changes in interest rates prediction in the media, ranging from 0.5 rise in interest rates to 0.5 fall. So he's saying, because of the uncertainty, manager has decided to protect the Mercy by using derivatives. Treasury manager wishes to take advantage of favorable interest rates movements. So this is something that we need to look at. Therefore, she's considering options on interest rate futures or interest rate collars as possible methods of hedging, but not interest rate futures. So using options or collars, but not futures. So they can invest at Esther minus 40 basis points, and Esther is currently 3.6%. So the manager has obtained the following information on euro futures and options. We have a 3 months euro future of 1 million. This is the contract size. I have a tick size of 0.01 and a tick value of 25 euros. Then, so we have September, December, and March. Then we have options on 3 month euro futures, 1 million contract, tick size 0.01%, tick value 25. Options premium are in annual percentage. So we have been given the futures, then we have been given also the options. So the options, of course, have usually the calls and the puts, because the call option is the option to buy, whereas the puts gives you the option to sell. Then, of course, the strike price is also given, and you normally have, so sometimes they give you one, sometimes they give you two. But in the question, when they give you more than one, but you are just trying to find out maybe if you're going to look at an option, then you can just choose one of them. Here where we have callers, there is also going to be some other thing to deal with. So now it can be assumed that settlement of the contract is at the end of the month. It can also be assumed that the basis commission is to 0 at contract maturity. The constant rate and the time intervals can be calculated in bounds. So, and then they are saying that based on the choice of options on futures or collars, so we are doing either futures, options on futures or collars. Mercy is considering and assuming the company does not face any basis risk. Recommend the hedging strategy for the 25 million receipt. Support your recommendations with appropriate comments and relevant calculations. So those are the 2 questions as we have them. So let us first start with the first one. if we go to the scenarios and then read the scenario for the first one. So the Armstrong Group is a multinational group of companies. And today is 1st September. The manager at Messi, one of the Armstrong Group subsidiaries based in Europe, has just received notification from the group said office that it intends to introduce a system of netting. So they are going to do a system of netting, settle balances owed within the group every 6 months. Previously, intergroup indebtedness were settled between the two companies concerned. So the predicted balances owing to and owed by the group companies at the end of the February as follows. So this is by the end of February. So we have owed by and owed to. Then we have the currencies. So now Armstrong owes $12.17 million to Holland. Then Holland owes Massey 42.65 million rands. And Giffen owes Armstrong 21.29 million. These are, I don't, crowns. I don't know, I've forgotten how they pronounce the Denmark currency. Then Massey owes Armstrong 19.78 million dollars. Then Armstrong owes Massey 1.57 million euros. Holland owes Giffen 16.35 million. Then Giffen owes Massey 1.55 million euros. Now, the rates are here. We can be able to convert between all these currencies. Settlement is made in dollars, the currency of the Armstrong Group. So settlement will be made in the order that the company owing to the largest net amount in dollars will first settle. The company owed the smallest net amount in dollars. Oh, okay. They are here. This is the Danish krone, South African rand, and the US dollar. Then we have euros. So this is the first one, and they are saying calculate the intergroup transfers that we are going to forecast. Now, when you look at it, you have several amounts that are owing and owed by different people, and the idea is we have to convert them to dollars because they say that settlement will be made in dollars. So this is what that statement says. So everything, because the group is going to have to pay in dollars. So it will have to settle in dollars, and it will be made in the order that the company owing the largest net amount in dollars first settle with the company owed the smallest net amount in dollars. So now, of course, Armstrong already is owing $12.17 million. That is okay. Then Oran is owing, but it's South African rands. Then Giffen, and so on and so forth. So we are going to first of all determine these amounts in a given currency, which is going to be dollars. Convert all of them. So that's what we are going to start with. So we have, let me see if we can copy this. That will save some time. Okay, so we have amount owed by, owed to, then we have the local currency. It's in millions. So what I'm going to do is just to add another column here for the local currency itself. That we have here US dollars 0.17, South African rands 42 point. Then this one is the Danish krone, 21.29. Then we have here the US dollars, then we have euros, $1.57 million. Then we have the crowns here, then another euros here. So these are the figures. Now we need to convert them to amount in dollars. So let's convert to dollars. And let's say if we are going to use also millions. Of course, these ones are going to stay the same because they're already dollars. What about rands? Now, we know that 1 rand is equal to, so remember we are converting dollars. 1 rand is equal to 0.932 dollars. So you can say that $1 is equal to 10.7296 rands. Now, sometimes that may be the same thing. Let's see. So these are the same. So these, you know how these cross rates work. So if I'm looking at rands and I want to convert dollars, if I have rands, I can multiply by $0.932. Or I can just get the same by dividing by 10.729. So let's do 0.932. So shall get this one multiplied by 0.932, which gives us 39.74. Those are our million dollars. This was 0.0932, not 0.0932. So that is 3 point. So and let's deal with two decimal places. So 3.97. Then to convert to we have here, I have 21.29 crowns to dollars. So 1 crown is equal to $0.1823. So I can multiply this one, $0.1823. That gives me 3.88. Then we can continue like that. So now we want to convert the next one. Is already $9, so that is okay. Then we also need to look at the euros. So 1 euro is equal to $1.3591. So we multiply that by 1.35. 91. And then we have the next one is in crowns. So crowns, we already have a figure. We can just copy the formula here, 2.98. And then finally, again, we have euros. We can copy this one.
Hello?
Yes.
On the current 16.35, okay, you were moving a little fast.
Oh, I'm moving a little fast. Okay, it's fine. Where on the crowns, this one of 21.29?
No, the 16.35.
Oh, okay. So because we understood the first one we did here.
Yes.
Yes, and so because we already had the conversion of 1.8323, I just put it here because it's the same currency. So I copied this formula to this cell.
Okay.
So now we have the amounts that are owing in dollars. Now they said that the settlement will be made in order that the company owing the largest net amount in dollars will first settle with the company owed the smallest net amount in dollars. So now, largest amount is the Mercy. Okay, so that's the one which is 19.7, and the one which the smallest amount in dollars is given. So, but remember they're saying that the company owing the largest net amount. So which company is owing the largest amount? The company which is owing the largest amount is Mercy. Then the company which is owed the smallest amount is given. So this one here is Mercy. This is also Mercy here. It was not clear. So Mercy, then this one here, the others are okay. She's also Mercy here. So now Mercy is the company which is owed the smallest amount, 2.11. So when we are going to clear, we are going to start by saying the company which is owed to, in this case, given 0.11. Okay. Then the company which is owed. So let us first set up our system of the transfers. So we are saying the company owing the largest net amount in dollars will first settle with the amount owed the smallest net amount in dollars. So if you set up these companies, so if you say which company is owed to, so we have Oran, have Mercy, have Giffen. So which one is owed to? The largest amount in dollars. This one here. Okay. Mercy is Armstrong is the one which is owed to the largest amount. So, but Giffen is the one which is owed to 2.98, then followed by Mercy. So Giffen is the one which is owed by Mercy 2.11. So we shall start with the company, which is in this case, we shall start with Giffen. So Giffen need to know the companies that it is where this is owed by. So
Hello.
yes.
I'd like to ask.
Yeah.
Would someone be wrong if, for example, after converting it to dollars, then you organize your data based on, as you have explained, like O2, then okay, basically under O2 you just follow the way the question was, like you go from Horan to Mercy or Armstrong, or you have to follow the part of the question where it says it begins from the smallest, from the largest to the smallest. Would they be penalized if you basically followed the column of old two, but still derived at the same answer?
Now, the cash flows that are going to move here, you find that since we are going to have to make conversions, it matters the order you follow. If we first, for example, if I were to list here, let's say I'm going to say here, company owed. If I want to say owed by, then I'll have here Armstrong. Then I have Oran. Then I have Giffen. Then Massey. Okay, so those are the ones that are owed by. And if I'm trying to determine the total for Armstrong, Armstrong appears here. And it also appears here. So it is owed. Armstrong is owed 14. Armstrong is owing $14.3, $14.3 million. Then if I'm looking at Horan is owed that is 3.9 here. And it again shows up again here, 2.9, that is 6.96. Then Giffen shows up here and also here. Then Massey, 19.7. I think Massey appears only once. So now Massey, these are the owed by. Now, if I set the owed to, again, I'll have the same companies. I'll have Horan, have Massey, I have Armstrong. Wait, I have two Armstrongs. Let me first confirm that. Okay, yeah. I have Armstrong twice. Then I have Giffen. So now Horan is so where we say who's owing Horan. So we have this 12.7. What else? I think only that. Then Massey have 3.9 plus this 2.13, which is 6.11. Then Armstrong, we have 3.88 plus 19.7. And then Giffen only once, 2.98. Now, they said net amount because they said that the company owing the largest net amount in dollars will first settle with the company owed the smallest net amount in dollars. So you see, Giffen here is the one that is owed by the one which is owed by the smallest amount, 2.98. Then follows, no, this is given, then it will follow Massey, then follow Horan, then follow Armstrong. Okay, but if you are to look at it in terms of the net, because Horan owes 6.96, but is owed 12.17. Then Armstrong owes 14.3, but is owed 23.58. So if we are to look at the net.
Wait, hello?
Yes, yes.
For Massey, isn't it 8.21? Because if you get, yes, 3.97 plus 2.13.
I missed something. So it's 3.97 plus 2.13 plus 2.11. Yes. Yeah. So
then hello?
Yeah.
Also for Armstrong, isn't it
there's this
3.88?
Yeah. Then there's the 19.78. No, we are taking dollars. Oh, this was 7.8.
Yes.
Yeah. 23.66. So we have given 23. Armstrong 23.66. We have Massey 2.98. Then we have Armstrong 12.7. Okay.
Yes.
Yeah. So now, which company has the largest? Which is owing most? It is Massey. Okay, with 19. So 19. Now, of these companies, which one has the lowest amount? Because remember, we're supposed to look at the net amount. So the net amount. So if we are looking at Armstrong, Armstrong is owing 14.3 and is owed 23.66. So now, remember, the one that is owing is the payable. So we are going to take it to be the negative. Then the one who is owed to is the receivable. So if I'm getting 20.66 minus 14.3, so Armstrong is in a position of 9.6, 9.36. That's what Armstrong will be. That will be the net for Armstrong, right? So, yeah, a net receivable in this case. Then for Horan, if I say 12.17 and I subtract 6.96, I have 5.21 as the net receivable for Horan. Then if I get given 2.98 minus 5.99, so given is in a position of a payable of 3.01. And then for Massey, 8.22 minus 19.78, a net payable of 11.56. So now, which means that Massey is the one which is owing the highest amount on a net basis. That is Massey. Then followed by Giffen, followed by, now Armstrong has the highest receivable, then Horan has the lowest receivable. And they say it here in the statement, they say that the company with owing the largest net amount will first settle with the company owed the smallest net amount in dollars, which means that Massey with the highest, or you say Massey owing the highest net amount will pay will pay Horan $5.21 million, okay, being the lowest net amount. So that's what will happen. So Mercy.
Hello? Hello?
Yeah.
I beg your pardon.
So we have said that Mercy is the one which has the highest payable. And the Horan is the one which has the lowest receivable. And the statement here says that the payment is made in order that the company owing the largest net amount in dollars will first settle with the company owed the smallest net amount in dollars. Which means that Mercy will first pay Horan. Okay, so Mercy pays Horan. So which means that Mercy pays Horan $5.21 million. So that is $5.21 million Mercy has paid Horan. Now, of course, now Mercy will have to go to the next one, which is Armstrong, right? So
yes.
Yeah, so Mercy pays Armstrong. Now, remember it was owing 11.56, it has paid 5.21. So if you get 11.56 and subtract 5.21, remain with 6.35. That is owing, right? So it will pay Armstrong 6.35. So that means that it has finished paying its 11.56, right?
Yes.
Yes. Then now we go to Giffen. Now, remember that Armstrong was owed 9.36. So if you get 9.36 and subtract the 6.35, what is left is 3.01. So Giffen pay Armstrong $3.01 million. These are the payments that, yeah.
Hello?
Yeah.
I beg your pardon on Giffen.
Okay. So now remember that Mercy has finished paying his 11.56, paid 5.21 to Horan, and he paid 6.35 to Armstrong. That's done for Mercy. So the other person who comes next is Giffen. Giffen is owing 3.01. So what I wanted to see is if Armstrong is still left with how much money. So they had 9.36 they were added to as a receivable, but they had paid 6.35. So what was left was 3.01, exactly how much Giffen is owing. So that means that Giffen will pay that 3.01 to Armstrong. So at the end of the day, Mercy, Giffen have all paid out, because now what we are doing here is netting. Remember that Mercy and Giffen, everyone had a receivable somewhere. You see it here. Everybody had a receivable somewhere. But it doesn't make sense for Mercy to say that, okay, I'm going to pay 19.78, and you guys also pay me 8.28, 8.22. So it would make sense for Mercy to just pay the net of the two. Okay, that's why we are saying Mercy has to pay 11.56, the net of the two. Then you go Giffen also. Giffen was supposed to pay 5.99, but was supposed to receive 2.98. Therefore, you should just pay 3.01 as the net. So that's how we get this net amount. Now, ideally, if there were no rules of who pays first, then you would just say Mercy can first pay this 9.36, and the remainder he pays to Horan, and then Giffen pays the remainder to Horan. That would still work. Everybody would be paid. But because they told us that the one owing the highest amount has to pay the one owed the least amount first, that's why Mercy first pays given 3 point. First pays, I mean first pays Holland, who's the one which is owed to the least amount, 5.21. Then whatever amount is left on there, 11.56, they pay up to the Armstrong now. So Armstrong now was owed 9.36, and they had paid him 6.35. So he was left with 3.01, which happens to be what Giffen is owing. So Giffen will just pay that 3.01 to Armstrong. So at the end of the day, everybody has received their fair share. This is what we call netting. Yeah. Okay. Yeah. So now the question that you had asked me before, which we were supposed to do, and for some reason you didn't do it, was also somewhere like that. You can see here that we had owed by and owed to. So we were supposed to first do the netting process before you can come to the figures that you use. Maybe what you can do now, now that you've seen this, try to go back and figure it out. If it fails still, you let me know that this is a question we do tomorrow.
Oh, okay.
Yeah. So that is the first part. So now that is for 7 marks. So you would have to set up owed by, owed to, then you net, then you come to the conclusions of how the transaction will be. So the second part was the one of the receipt. Okay. They told us that we are supposed to use 2 things, because they are going to receive money and then we want to invest it. So remember, we are going to, the company is going to receive some money in 6 months, 25 million on 30th November. So then they want to invest the money until 31st May. So now with interest rate, because I thought this question was going to go straight to FX. By the way, did you look at the question I shared, the previous question of Washi? Because it was FX. Have you looked at it?
Yes. Yes.
Okay. Was it clear? Did you find issues?
Because I wasn't able to attend the class, I majorly did the question that you went through when I wasn't there.
Okay. So and you should do that question Washiko, and see if you understand it or if you need me to guide you there, because it's about FX. So here we are going to look at the one of interest.
Okay.
Interest rates, the hedging that you find in the exam, you're going to find forward contracts, then you would find futures contracts, then you would find options on futures, also just code options, but because the examiner today has called it options on futures, and that's what sometimes they calls it, but that's option. Then we can have, sometimes we have callers, which I think in this question they are asking us to deal with the options or the callers. So now these are the 4 methods, and if you go to the, I don't know if you are you using this study hub? Something that you should use. You are using it? Yeah. So
No.
you should use you know how to access it?
Yes.
Yes. So at least you can, even if you don't go and look at every piece of the topic, at least you should go where there's quizzes and practice. So that in case you realize you don't understand something, then you can come to the chapter and look at it. Because now, like here, what we are looking at is chapter 15, interest risk management. And you can see we have here the forward rate agreements, then we have the over-the-counter options, then we have the interest rate futures, then we have the options, then we have swaps, and we have collars. Okay, collars are not maybe mentioned here, but they are dealt with perhaps under options. But at least that if you go here, you can be able to go through it, and you have a faster idea of how to deal with, because they have this section which helps you to how you're going to hedge, give an example, and then you'll be able to follow very well. So for example, here in this question, we saw things like tick. Okay, we saw things like tick size and tick value. So here they will be explained very well. Okay, let's see if they have explained the ticks. So, okay, at least they are using them here they are using them in this example. Maybe they have been explained in the previous section that I've skipped, but at least they are using them here, so you know how to use them. So, but anyway, we are going to look at this question, and it will give you some idea of how to deal with it. So now, when we are going to deal with interest, we have to ask ourselves, are we going to invest? That means, are we saving or depositing, or are we borrowing? Okay, because remember, when you go to the bank and you take out a loan, they give you an interest rate, but you are the one paying that interest. So for you, your worry is that interest rates will increase. But if you went and deposited your money in a forex deposit bank, or you create a foreign exchange account, an FD account, and you deposit your money there, so for you, your worry will be that the interest is going to decrease. So the worry depends on whether we are investing or whether we are borrowing. And now in this question, we are actually going to invest. So in this case, we are going to invest. And because of that, we are worried that the interest rates decrease. That's our worry. These are important things to come up with when you are doing a question of interest rates, so that you know whether you are going to worry about a fall or an increase. And if you are depositing, you buy call options. So if we are depositing, we buy call options. The reason why we buy call options, since we are aware that the FX is going to decrease, remember, call options are options to buy. So if we think that the FX are going to decrease, we normally hedge against that. And you know that when interest rates decrease, what normally increases is the value of the option, or actually you can say the futures amount, because usually the future amount is the one which increases. So the value of the future increases, and vice versa. So if we are depositing, we are aware that the interest rates are going to decrease.
Hello?
So, yeah.
So, in the event we are receiving, that means we are going to go for a put option. Is it?
If we are going to,
like in the event we are receiving, basing on what you've explained, does that mean that we shall go for a put option?
but you said in the event that we are going to receive, right?
Yes.
But that one is going to work when you are looking at FX, because remember here we are either investing or borrowing.
Oh, okay.
So yeah, if we are going to deposit or invest, that means that we buy call options, and if we are going to borrow, then we buy put options. Okay, so that's what I was trying to explain to you here, is that the reason why we buy call options when we are investing is that since we are aware that the interest rates are going to decrease, the futures price will increase. So you hedge against it by doing the opposite thing, by buying options that allow you to buy. So that if the FX rates actually increase, then you are going to make a profit on that hedge, which is going to balance out your loss. Okay, so these are the things that they say the choice. This is the option. So and if you look at here, the principal include. Okay, let's look the cap and the floor. I'm trying to see if there is a summary here. There's no summary. So let me just continue with this. But you read there, you find there is information that can help you. But if you are going to invest, you always buy call options. And if we are going to borrow, we always buy put options, which means that in this case, we shall buy call options. That's what we shall buy, call options. So now, the procedure for this, you normally need to know how many contracts. So how many contracts are you going to need? So if you look at the question, the contract is in 1 million euro contract. And we are going to receive 25 million euros, right?
Mm.
So we are going to divide 25 million euros by 1 million euros. But we don't stop there, because we are going to invest this thing for 6 months. So we multiply by 6, divide by 3. Now, let me explain to you why this formula works like this. First of all, we need to know how much money we are receiving, 25 million euros, divided by the contract size, which is 1 million euros. But we multiply by 6 out of 3. Because these contracts here are usually for 3 months. That's why you see September, December, March, and June. So it's usually 3 months. So September, October, November, then you get the one of December. So December, January, February, then you get the one of March. So it's usually 3 months between them. So which means that even if we are going to hedge for 6 months, we try to kind of balance it for the fact that each of those contracts is for 3 months. So this ratio helps us determine how many contracts we shall need to complete a hedge those 6 months. So we need 50 contracts. Yeah.
I'd like to ask,
Yeah.
there's some questions I've done under options where when I try it on my own, and okay, I'd like to know, when do you do the, like, now in this particular case, because we're going to okay, in the how do you know when you're supposed to include the part where you get the number of months divided by the divided by 3?
By 3. Yeah.
Yes.
When you are determining the contracts for interest rates.
For interest rates.
Yes, because when it comes to FX, FX, there's no that there is some months that are going to happen. No, for FX, normally you are going to exchange some money on a given date. So for it, you just divide you divide the amount by the contract size. For
Oh,
FX, yes,
okay.
yeah. But for interest, because it has that part of for how long are you investing? So that's why we normally multiply it by 6 divided by 3, which is number of months divided by 3, which is usually the size, the length of the contract. So now we know that we need 50 contracts. So after knowing that we need 50 contracts, so then now, right now, because remember they told us that we can, where is it? We can invest at Esther minus 40. Right now, Esther is at 3.6, which means that the current futures price at the moment if the futures were for now, it will be, now futures price is always 100 minus the interest rate. So because we are using Esther, you subtract 3.6. So that's the current futures price, 96.4. Okay. So now to get now the basis, so the basis is normally going to be the 96.4 minus, so let's go and look for the amount, because remember the basis, you know how basis is. So since we are going to borrow on 30th November, so we shall choose the December contract. Understand that part?
Yes.
Yes. So now the basis is the difference between the current futures
Later.
price and this 95.76.
Yes.
Yeah. So 95.76, which gives us 0.64 as the basis. But how many months are there between now and when we get the loan? So right now, because we have done this on which date is it?
The,
The date tell us the date. Before we reach November.
Is it to receive it in November and they're
Yeah.
investing it till 31st of...
So we are receiving in November and we are doing December. So there's 1 month there. But we need to know which date it is where, so that we can know how many months in total. The next month, not okay. Let's see. They normally give you the date. They gave us some date up. It's 1st September. So September, October, November, December. So there are 4 months between now and the December expiry. And we shall have left 1 month there because we are receiving on November 30th. So the unexpired basis is going to be 1 out of 4 multiplied by 0.64. So do you know that thing of the basis thing?
Hello?
Yeah.
Okay, there is a part that confused me. I don't know if you could go back to the question.
Yeah.
They say that the most significant transaction with Messi is due to undertake with the company outside Armstrong Group in the next 6 months, and that is due to receive 25 million on 30th of November.
Yeah.
So then, but then they're saying that Messi's treasury manager intends to invest his money for the 6 months until 31st of May.
Yes. So you're wondering why we're taking December futures?
No, for the December future, it's understandable.
Yeah,
But why I got confused is when we were looking for
the
the
basis.
date, because they usually tell you the current date.
Yeah.
As a little confused why we didn't look at November and May. That part
Mm.
confused me a
So
bit.
this date of November is when we are going to receive the money. So I don't think it can be the current date. And then the May 31st is the date when we are going to invest from November until May. So both of them are not the current date. And that's why I went back to this question, because they're saying that today is 1st September. The thing that they said here in this part, because this part is a continuation of that question, and this is just another part adding that the most significant transaction that's
Oh,
going to happen in those 6 months is this transaction.
oh, is it because you're trying to hedge against the interest rate going uh up
Down. Yeah, going
up or
down.
down
Yeah.
when you anticipate to receive the loan in November? Is it?
Yes. Because
Oh,
when we receive the money in November, we are going to have to invest it for 6 months, but we don't know what will happen to the interest rates. So that's why we are hedging.
oh, okay.
So now the unexpired basis is 0.16. So it now helps us, the unexpired basis is going to help us determine the expected futures price. So now there are two scenarios in this question, because they said, based on the option, recommend a hedging strategy, but they did somewhere where they say that the interest rates can move. There's a range of 0.5 rise to 0.5% fall. So we are going to deal with both of them. So let's increase. So if interest rate increase by 0.5, so that means that, remember that the interest rate right now is ESTA, which is 3.6. So if it increases by 0.5, it becomes 4.1. ESTA will become 4.1. Therefore, the expected futures will be now, remember, the price is 100 minus 4.1. That's the price, but we have to subtract the unexpired basis. So that is going to be the expected future 95.74. Yeah,
Why did you call it the unexpired basis?
because remember right now is 1st September.
Oh, it hasn't yet,
Yeah,
because
we're in 1st
it's
September.
expiring in December.
In December, yes.
Yes.
So by the time we get the loan, there will be 1 month left on that future. So that's why we do 1 out of 4 times the basis.
Okay.
Yeah. So the expected future will be 95.74. Now we have two strike prices. So we are going to test both of them. So we can have here the exercise price. So if you change the one of 96.5, or you can use the one of 97.00. So now,
Hello.
yeah,
Why did we subtract the unexpired basis?
this is how you get the futures that you are predicting using. Because remember, what we are doing here
Oh,
is basically like
oh,
interpolation.
Oh, okay. Is it because usually in the tableau form, okay, like how someone else would do it, they would put the current against the future, like on your right. So it's easy for you to, like, after you computing the basis,
Yeah.
the figure sort of becomes as it the expected future is more like a balancing figure. Is that yes?
The expected future of 95.74.
Yes, it's more of like a balancing figure between the 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 the
current one
the
and
current one
the
minus the
unexpired basis.
basis.
Yeah. Yeah.
Okay.
So now the futures price is 95.74 in both cases. So now the question that normally comes with options, because options have to give you the choice to exercise. Remember, these are call options. So if you can buy at 95.74, okay, in the market, or if you can use your exercise price of your option of 96.5, which one would you use? Remember, we are buying.
I beg your pardon.
Because we are having call options, if you have an option to buy at 96.5, but you can also go and buy at 95.74 in the market, what would you do?
I would go for the 95.74.
Yes, so in this case, we shall not exercise. So this is what we are trying to determine here. So in this case here, I don't exercise. But in this case, because you can buy at 97, and again, you have an option to buy at 95.74 in the market, again, you don't exercise the option because it makes you buy at a higher price. So, yeah. But with these options, even if you don't exercise, you still have to pay premium, right? So
Yes.
So in this case, if you don't exercise, there's not going to be any gain. So that will be 0. Then you'd have to, of course, now
Hold
yeah.
on. The 96.5. I was wondering if you could go back to the question so they can see where you got it from.
The strike
Oh,
prices.
it's the strike price.
Yeah.
Oh.
So we are testing both of them. Ideally, in the real world, they test both of them, but in the exam, you could do one, but I've seen the examiner is always doing both of them. So you just do both of them. It doesn't take long once you understand the procedure. So there's no gain because you have not exercised in either case. Then, of course, how much interest will you receive when you invest? So remember, you are investing 25 million and you are investing it for 6 months. And the interest, remember, we are able to receive interest at A star minus 40 basis points. So A star right now is 4.1% minus 40 basis points, which is 0.4%. So basically, you would earn 460 to 500 in both cases. Okay, so then you also pay premium. The premium is always the one which is given to you. So for this 96.5, the premium of the December is 0.182. Okay, so 0.182, and this is always usually in percent. So in terms of basis points, that is 18.2. So 18.2 and you are paying it for 25 million, and you are paying it for 50 contracts. That's what we need to. If we are looking at contracts, then we are multiplying by the tick value, not by the 25 million. So that is 18.2 multiplied by the tick value, which is 25 pounds, and the contracts are 50 like we determined. So that is 22,750. So that was the one of the 96.5. The premium is going to be negative. Then here for the one of 97 is going to be 3.2 multiplied by 25 multiplied by 50 contracts. Yes.
You're moving a little fast.
Oh, okay. On the premium?
The second one, how you got the 4,000?
We have here 0.032.
Oh.
Okay. Yeah, which becomes 3.2 because this is 0.032%. Okay. Now, if you want to, because the way you do it here, you are basically getting the basis points. So, and you know each tick size is 0.01. If you divide this one by 0.01, you end up with 3.2. Okay. Then that 3.2, you multiply it by the tick value of 25 pounds. And then you multiply it by the contracts, which is 50 contracts. Yes, so that's how we get this 4,000. Now, in this case, we don't have any gain, so we can get the net receipt or net payment. This case is a net receipt. So 439, 750, and 458, 500. Then from there, you can get the effective interest rate, which normally is got by getting 439 divided by the 25 million. Okay. But because you are only investing it for 6 months, multiply by 12, divide by 6. You know that part?
Yes.
Yes. So, which becomes, we put it percentage terms, that is 3.52 and 3.67 respectively. So this is if the interest increased by 0.5. And once you get that one, you can just copy everything and do the other second part.
Hello?
Yeah?
First go back to the 3.52.
Okay. So you get the net receipt divided by the 2.5 million, the 25 million. That's the one we are going to invest. Then multiply by the fraction, which is we are only investing it for 6 months, so 12 divided by 6. Yeah. So now we look at if the interest rates decreased. So if they decreased by 0.5, remember that it was at 3.4, 3.6, so it becomes 3.1. It becomes 3.1%. So that means that the expected future is going to be 100 minus 3.1, then minus an expired basis. So exercise price is going to be 96 and 97. like before, but now the futures price is 96.74 and 96.74. So we have to choose here based on the fact that you can buy at 96.5 using your option, of which if you don't use it, you buy at 96.74. So you exercise here, right? Even here, because you are buying at 97, 96, here I don't exercise. Because if you exercise, you buy at 97, yet if you don't exercise, you get 96.74 here. So here you still stay, no exercise. So now the gain here is going to be 96.74 minus 96.5, which is 0.24. And then here there's nothing. So what you are going to find that in the exam, sometimes they say gain in basis points, and they multiply this thing by 100. To get their 24. Okay, so you find that basis points, they will put 24, but you can have left it as gain and you just put 0.24. So now, of course, interest received, now this is going to be 3.1. Even here, 3.1. Then the premium is going to be the same. So now we can maybe just add here one more line before we add. The gain in dollars. Or actually it's not dollars. It's in euros, right?
Yes.
Yeah, gain in euros. Because the gain up is in basis points. So now the gain is going to be the basis points. We multiply by the tick value, which is 25. Multiply that one by the contracts, which is 50. That's how you get the gain in euros. So the net receipt is now going to be the sum.
Please hold on.
Okay.
How did you get the gain?
The gain, you multiply the gain in basis points by the tick value of 25 by the contracts.
Oh, okay.
So now the net receipt is going to be 344,750. Of course, which becomes 2.76% and 2.67%. So that is when it comes to getting the options. So it means, of course, the interest rates are going to decrease, but to 3.1 you lose. But if they increase to 4.1, still you get effective interest as 3.5, but at least it's not going to go below. Because remember, since we are investing, it is beneficial for us to have the interest go up. That's why it is beneficial. Now, that is the interest rate options. Now, when it comes to the callers, now a caller, I don't know if you know how a caller looks like. Just see if I can, an image can come a good one, just to illustrate. The color looks sort of like this. like this. It has like, basically it has a bottom, which is, and also a top. But in interest rates, the way we look at a collar is that a collar is going to set both the maximum and the minimum interest. So that's what a collar does. A collar sets both the maximum and minimum interest. So the idea here is, you see, when you set an option, if the interest rates move, if they increase, like in this case, we didn't exercise because we are okay to just go by how things are. But if they decreased, we exercised. Now, if you bought a collar, what it does, it hedges this transaction like we have done, but it also creates a minimum. So it creates a minimum and a maximum. So the reason why people do that is this premium here. You see, premium is expensive. And even if your hedge doesn't need it, you already have incurred it, right? So, which means that what people do is that they instead do what we call buying a collar, whereby they sell and buy options, right? So that situation, what happens is that if you do so, when you sell options, remember that somebody is going to pay you premium. And when you buy options, you pay premium. So by doing both of them, then you net, and therefore the premium amount becomes lower. But now it fixes you in the middle of those two, just like how that collar looks like. It has a wider part like this, then it has this other part, and has a lower, wider part here. So when you get a collar, you fix a maximum interest and a minimum interest, which is going to put you in the middle here. So if the interest goes higher and you are depositing, you won't benefit, because you won't benefit beyond the maximum. But if it goes lower also and you are borrowing, again, it won't go beyond this, so you will still be fine. So that is what we call a collar. So how does the collar work? You have to have known how the option works. Now, since we are buying call options, so for collars, we shall buy call options because that's what we need to hedge our transaction, but also sell put options. That's how the collar works. Buy call options, but also sell put options. If the first transaction we did was for buying put options, then we should have also bought, okay, put options and sold call options.
I beg your pardon.
So the first transaction we did here was to buy call options. So if we want now to do a collar, we have to buy call options like we did, because that's the transaction that we need to hedge, but also sell put options. So by doing so, we shall receive premium from our sale and use it to reduce what we are paying for the call option.
Okay.
Yeah. So it's like a netting thing also. So now, in this case, what do you do? Because you have two strike prices. Okay, so what you are going to do, you're going to buy call options and sell. So the premium on the options is this. Okay. So if you buy call options at the one of 97, you will be paying premium of 0.3032. And then you sell now put options at 96. Then you receive 0.182. Then the net is what you are going to receive, right?
Yeah.
So, yeah. Or you can do the other way around. You can buy at 96 call options of 96 and sell put options, okay, at 97. Then you calculate. So here what we are going to do, we are going to buy at 97, we are going to sell those of 96. So we are going to buy all options at 97. So what will be the premium payable? So call options of 97, we are paying 0.032. Then now we are going to sell put options at 96.5. So what is the premium? This is the premium payable or receivable. So payable, I'm going to make it a minus. So if I'm selling put options of 96.5, the premium is 0.123 that I'm receiving. So the net premium receivable is 0.091. So which means that I will receive premium of 0.123, I will pay 0.032, means that I will have received premium of 0.091 from this transaction. So at that point now, I can now go and start looking at, again, what will happen if the interest rates change. So we don't have to do any more math, which is very confusing. We can just copy this thing here. Because we are basically looking at both of them again, but now looking at options, I mean callers. So the future price is going to still be 96.5. Then exercise price. Now, remember the exercise price, we are not going to worry much about the selling part, because the selling part is just to reduce our interest, our premium payable. So we are using call options of 97. So we shall put 97 here. These are the ones that we are buying. Then we are selling the put at 96.50. Then futures price is here 96.5. So again, we ask ourselves the same question. If I can buy at 96.5 in the market, but my option lets me buy at 95, this is 97, not 95, but makes me buy at 97. I don't exercise, right?
Yes.
Yeah, don't exercise. This other part, we don't even have to worry about that. Can leave that part alone. So I don't exercise, so there's no gain. This is the interest. But now the premium is not going to be 18.2, because we said the premium is actually now 9.1, and it's not even negative, it's a receipt. So 9.1, that's the purpose of having that caller. So the premium becomes a gain on our side. And then therefore the net receipt becomes 473. So, but there is something which we need to also consider, because anyway, we need to also consider this person of the put, because this person of the put, the future price is 96.5. If you have an option to sell, no, not 96, is it 96.5? Let's see where that comes, where I'll put that. No, 95.74. 95.74. So now this person here that we have said we have sold our put option, we have sold him a right to buy, to sell, because it's a right to sell, put option. We have sold him a right to sell at 96.5, whereas he could have sold at 95.74. So would he exercise? Yes. Okay, because our option lets him sell at a higher price. So because of that, the exercise, then for us, we actually make a loss. So before you bring the net receipt here, I'm going to actually put here a line for the loss exercise, put option. So now, what's the loss on that exercise? So difference, what's the difference here? First of all, is 0.76, right? So by them exercising, that's the difference. So we can make that difference. Remember, this difference is always in basis points. So you can multiply by 100. That's why it is 76. Now we multiply this thing by the tick amount and the contract size, the number of contracts. So we shall have made a loss of 95,000. Yeah.
Wait. Why are we including the loss under the
Under our situation of the call.
Or is it because under the call option you get the difference?
So what we do is that we don't want, because if this person exercises, what it means is that we are going to pay them, because remember the option is that they are going to be able to sell at 96.5. So because when the exercise is for us, we have to pay out this money. Remember, we are looking at our side, and the transaction that we are looking at is the call itself. Just that the put helped us to reduce the premium, but also it has effects that it's going to also have us incur some money in case the exercise. So that's why we put it on this side. On this side is a positive on the sell part for the person who has got these put options. But on our side is a negative.
Wait, so like under the sell option, when we compare the future price and the exercise price, we're exercising because you're going to get more when you sell.
Yes, with the option. Because you can sell at 96.5, whereas if you don't use the option, you sell at 95. So there is basically a benefit for you to sell using the option.
So to get the loss under
get the loss, you get the difference, okay, which you want, you can actually just get it from here like that. Difference is 0.76, but these are basis points, so that's why we multiply by 100. Okay, then you multiply by the tick value, which is 25 euros, and the contracts, which are 50. So this one is what we also did up here when we looked at the gain. Okay, we got this one, and this one we had already multiplied by 100. So it's just that here we have just done it at once. This cell, we get the difference multiplied by 100, multiplied by the tick value, and the number of contracts. Okay. Yeah. So that gives you 3.03. Then we can now also look at now this same situation, but if the rates decrease. If the rates decrease, they become 3.1. So the future is 96.74. So in this case, if you could sell at 97 using the option, if you could buy at 97 using the option, but the future price is 96, so you don't exercise again for this for the buy in the call option. But for the put options, if the put option helps you to sell at 96.5 and the future price is 96.74, again you also don't exercise, which means that there's no gain for both cases. And I can remove now this column, this row. So here what we are going to look at is the interest. This is 3.1 now. Premium is going to be again a receipt of 11,375, and the net receipt is going to be 3.8 thousand, and that gives you an interest of 2.79%. So those are our figures. Now the thing that you need to do is to compare them so that you can be able to advise which one is to be taken. So we are going to compare for both of the exercise prices, 96.5, then 97, and the caller. So if rates increase 4.1%, if rates decrease 3.1%. Now, the one of 96.5, when the rates increase, was 3.52, the interest. The one of 97 was 3.67. And the caller $3.03. Then you go to the decrease part. Then we have 2.76, 2.67, and the caller 2.79. So those are the three options. So now, of course, it looks like
hello.
Yeah.
Let's hold on. For the part where we're saying that the interest rate drops by 0.5%, the part where you have 96.5 and 97,
Yeah.
under the, isn't that supposed to be 96.5?
This one, the futures price.
No, the exercise price. And
exercise price is 97 and 96.5. These ones here.
we
Yeah.
wait, just hold on, because I thought we, just hold on.
It's fine. It's fine. You can. I'm holding on.
Wait, the exercise price for the buy, when you buy the call option, it's 97, and when you sell it's 6.5.
Which one? This one. we said that we are going to buy at 97 and sell at 96.5. Okay, and you could have chosen it the other way around. So then, but the expected futures price, we get them from the ones that we got up for the options. Okay. Yeah. So exactly. So what are you still confused about here?
Okay, what confused me was because initially you say that you can just copy what you had and okay, what you did when you had the interest options.
For
So
the
I
for the
thought
part of
that
for the part of the
the buy option was at 96.5 and this option was at 97.
oh no, remember in the options we had to look at both of them. This was not buy or sell for this case. So the part that I've said that we have copied from up is the 97 part. You see all this part here, if you look at it, is what is here for the buying
Oh,
of the call options. It's just
oh,
that,
okay.
yeah. So the sell option for it now, remember we have decided that we are going to buy call options at 97 and sell put options at 96.5, which means that what I copy from up is the 96.5 call option. Then for the put option, it's a brand new column where I compare now the exercise price and the futures price, and I determine if I should exercise the
Oh,
option to sell or not.
oh, okay.
Yeah. It's fine. You can look at this again, the solution again, and follow slowly. See where you did not get properly, and then you let me know in case you still are confused. So now the decision in this case is going to remember we are investing. So the decision is where we have the highest interest, and of course, if the interest rates, yeah. Then are you trying to say something? Hello?
Yes.
Okay. I was saying, were you saying something? No? Okay.
Just hold on.
Okay.
Okay, first hold on a bit.
All right.
Where did you get the 34,875?
Oh, okay. So here I add the interest that is receivable and the premium which is receivable, the net premium.
Oh, okay. Mm.
So we proceed.
Yes.
Okay. So now when it comes to the decision now to be made, the you have to compare the three, like we said here, I put here in the summary. So if you look at these ones, if you look at the 97 option, it gives us the highest interest, 3.67, if the rates increase by 4.1%. And it gives us 3.67 when they decrease. So 3.67 is higher than anything, so we should accept it. But also, even if the interest rates fall, you see that the one of 96.5 is 2.76, whereas it's 2.67. So the difference is not so big. So it means that we can use the 97 exercise price or 97 option on futures. Okay. Then if you look at the callers, the callers are going to put us at a lower value than what the option itself gives us. But the argument here would be, okay, since the interest rates might increase or decrease, you see that if they decrease, we don't go as low as 2.67 or 2.76. We stay a little bit higher, 2.79. So it means that if the interest rates fall, we are not going to go so deep if we use the callers than if we use the options. But if the interest rates go up, we don't benefit fully because we only stop at 3.03. And that's what I told you about the caller. The caller is going to set both the minimum but also the maximum. So it is going to depend on whether we want certainty, which is what normally people want, or whether we want to have high gains. If you want to have high gains, then you risk it and take the 97 option. But if you want to have certainty whereby there's no big fluctuation, you see this one, the differences, if you look at the differences between the two figures, the fluctuation is very low. You see here, 0.24% if you used callers. Okay, these are just differences. Let me just put them in a different color. These are just the differences, the fluctuation between the highest and the lowest amount that you can incur. See that it's the one which is the lowest. So it means that the uncertainty that you have is lower compared to what you would have in these two options. So these are the things that you'll be telling the examiner that, of course, the 97 option is better because it gives us a higher interest if the interest rates were to increase. And when they decrease, even though it's lower by the one 96.5, but the difference is not so big. But the callers are good because they give us more stability as they fix both the maximum and the minimum interest, and the difference is not so big between the two. So I will leave you to read those ones for yourself in the solution, but this is exactly what is being mentioned here. So maybe what I can leave you with is, since now we have looked at the interest rate, it would be better, okay, if you come here and looked at this, either the interest risk management thing here itself and read the entire thing. It's not so big. Or you go to the quizzes and you look for the chapter that we have been looking at. It was chapter, I think, was it 15? And you do the quiz. And then also, if you got the practice, you get questions for interest rate. So here they are. We have Keshi, Holt, and Fitzharris. Yes.
I was wondering if you could share with me I don't know, like a link to get to the study hub, because our first challenge is accessing it like in the past. That's why I haven't yet gone to check it.
Okay, I'm going to send this link, but let me just show you how to access it. You see, if you go to ACCA Global, then you go to students, study materials. Normally, where I will go find the information that we need, ACCA, then advanced financial management. So when you go to this exam resources, there is this ACCA Study Hub introduction. Are you seeing it? This one. So when you click on it, there is information there, but what you are looking for is this login direct using your ACCA credentials. So when you click that one, it brings you here where you log in with your ACCA credentials. and then it takes you to that page. Okay, so it's going to load you to that page. So, but I'm going to send you the link. I hope the link, when you click it, it takes you to the page. But if it doesn't, then you go to use that method. Okay, so you see the page is loading, and when it loads, of course, here, depending on whether you have put it there, if you haven't put it there, you won't see it in the dashboard, but you can just search here, AFM. Okay, and you get the one of September 2024, because it may still have the other ones of June and March. So then you go to study, then you access the page, no problem. I'm going to share with you that link that I've copied. I hope that it takes you to the same page without going through that process. Yeah. You have any more questions for me for now?
Okay. In regards to the conclusion for the number we calculated,
Yeah.
the reason why you went with 97, is it because we are going to receive
Higher interest.
we're going to receive like okay, we're going to receive, and therefore us getting an interest rate which is higher means that you earn more. Okay,
Yes.
you get more.
So because we are going to deposit, and therefore for us what we want is higher interest. And if the question was about borrowing, then you would choose the one of the lower interest. Okay?
Oh, okay.
Yeah.
Then my other question is, have we yet gone through questions under forex exchange rate
Yeah.
hedging?
So the question that I shared with you last time when we didn't get class, Washi. That question, Washi, is forex exchange rate. Okay. But I wanted to do a question with you when you are physically present, so that you can ask questions and we tackle it together. So what you can do, just look at that question that you had shared with me before, the one that I flashed, this one, Kenduri. And see if what we have done today is going to help you with it. If not, then we do it tomorrow. Okay?
Oh, okay.
Then on Wednesday, we can now do a question on foreign exchange hedging.
Oh,
Okay?
okay.
Yeah.
Yes. Okay, but my question is, have we yet started like going through questions in foreign exchange hedging? Or
Yeah.
we are about to?
No, you know what? Last time we did go through foreign exchange hedging. That question, Washi. Okay. Let me just show
Okay.
it to you.
Okay, besides washi.
Yeah.
Okay, besides washi, are there any? Have you gone through any foreign exchange rate questions?
Like like in the previous classes.
Yes.
Yeah, I do have videos for those ones. You want me to share those videos?
If it was revision on first foreign
Yeah,
exchange
foreign
rate
exchange.
hedging.
Yeah. Of
Oh,
course.
okay.
But what I was saying is that we can still do a question together, because this question here, it had the NPV and other things, but also it had forex in there, so it has more to revise. But then we can still do another question, which is a section B question, focusing on foreign exchange on Wednesday, so that you get more and more an idea about it.
Oh, okay.
All right. So have a good night. You let me know if you need us to do that question tomorrow, or we do FX hedging actually. It's going to depend on whether you are okay. But I think we need to do another question also on interest rate hedging. So we shall look for another question on interest rate hedging. So we can do tomorrow. We'll do interest rate hedging, either your question or another question. Then on Wednesday we do another question for FX.
Oh, okay.
So have a good night.
You too.